Between midnight and dawn, something happened in the silver market that hasn't been discussed in boardrooms yet, but it should be. A price collapse, not gradual, not predictable, violent. The kind that erases positions before risk managers wake up. Here's what makes this different. No headline explained it, no central bank announced anything, no geopolitical shock preceded it, which means the trigger wasn't external, it was structural. And if you're holding silver exposure, or managing commodity risk, or simply trying to understand what just shifted beneath the global economy, the next 7 minutes will matter more than you think. Because what happened overnight may only be the beginning. Welcome back to the channel. This is your OG, John AG. Now, before we dig into what actually happened in that silver market, let me ask you something. The way I'd ask my father's generation, the folks who actually read the financial section with their morning coffee. If you've been watching these markets long enough to remember when information wasn't instant, when analysis required patience, when you actually had to think before you acted, do me a favor, hit that subscribe button. Not because I'm chasing numbers, but because this kind of analysis, the kind that doesn't scream at you or sell you false certainty, it's becoming rare. And if you value that, if you're here because you want strategic clarity, not entertainment, then subscribing is how you tell the algorithm that substance still matters. Also, drop a comment below and tell me where you're watching this from. Are you in New York, London, Singapore, Mumbai? Because silver doesn't sleep, and neither does capital. And I want to know where the serious money is paying attention right now. All right, let's get into what happened. On the night of February 5th, 2026, while most of the business world slept, the silver market experienced something unusual. Not unusual in the sense of a normal price swing, but unusual in the way it happened. The speed, the violence, the silence that followed. At approximately 2:47 a.m. Eastern Time, silver prices began falling. Within 18 minutes, the metal had dropped nearly 4%. For context, in commodity markets, a 4% move in less than 20 minutes is not volatility. It's a rupture. By the time Asian markets fully opened, silver had lost over 6% of its value from the prior session close. Traders who had positioned themselves for a continuation of the recent uptrend found their stops triggered. Automated systems executed sell orders. Margin calls went out before breakfast. And here's what made seasoned market observers pause. There was no clear catalyst, no Federal Reserve announcement, no geopolitical crisis, no industrial demand shock, no mine collapse or supply disruption, just a collapse in price. The initial reaction from most analysts was predictable. They called it profit-taking. They called it a technical correction. They suggested it was simply the market finding a new equilibrium after an extended rally. But those explanations didn't account for the character of the movie. Markets that are simply correcting tend to move in waves. They fall, pause, stabilize, then perhaps fall again. This wasn't that. This was what traders call a gap and run event. A price doesn't test levels, it simply blows through them. When investigators began examining the order flow data, a pattern emerged. The selling wasn't distributed, it was concentrated. Large sell orders hit the market in rapid succession during a period when liquidity was at its thinnest. The COMEX futures market, which serves as the primary price discovery mechanism for silver globally, showed dramatic spikes in volume during the crash window. But here's the critical detail. The buy side of the order book was virtually empty. In normal market conditions, when price falls, buyers step in at various levels. They see value, they accumulate, they provide support. That night, there were no significant bids until price had fallen substantially, which raises a question that should concern anyone with exposure to commodity markets. Why did buyers disappear? Were they spooked by something invisible to public markets? Were they responding to information not yet reflected in news headlines? Or had the market structure itself become so fragile that a relatively small amount of selling could trigger a cascade? The London over-the-counter market, which handles massive physical silver transactions between banks and institutions, showed similar stress patterns. Bid-ask spreads widened dramatically. Liquidity providers pulled back. The usual market makers who absorb volatility simply stepped aside. This behavior suggests something more troubling than a simple price correction. It suggests a loss of confidence in market depth. When professional liquidity providers retreat, they're sending a signal. They're saying the risk of holding inventory has exceeded their compensation for providing that service. By mid-morning, as European markets absorbed the overnight action, silver attempted a partial recovery. But the bounce was weak, tentative, the kind of recovery that suggests fear, not conviction. Options markets told their own story. Implied volatility spiked to levels not seen since the banking stress events of early 2023. Traders were paying premium prices for protection against further downside moves. The put-call ratio skewed heavily toward protective puts. This indicated that even as price stabilized, market participants remained deeply concerned about what might come next. Exchange-traded funds tracking silver saw unusual flows. Some institutional holders began liquidating positions. Not panic selling, but methodical, strategic reduction of exposure. The kind of selling that suggests risk committees held emergency meetings and decided that current positioning no longer aligned with acceptable risk parameters. And then, silence. No major financial media outlet led with the story. No emergency statements from exchanges or regulators. No explanation that satisfied the fundamental question, what just happened? The absence of clear narrative became its own story. Because in modern markets, when something significant occurs, explanations typically follow quickly. Analysts appear on television. Press releases get issued. Officials provide context. This time, nothing. Which meant that whatever had just occurred in the silver market was either not fully understood yet, or it was understood, but not yet ready to be discussed publicly. And that distinction matters enormously, because if this was a liquidity event, a technical glitch, an isolated incident, then the story ends here. But if this was a symptom of something deeper, a crack in market structure, a warning signal from the commodity complex, then what happened overnight wasn't the story, it was the opening chapter. To understand what happened that night, one must first understand what silver actually is in the modern financial system. Not what it represents to collectors or industrial users, but what it means to the machinery of global finance. Silver exists in two worlds simultaneously. In one world, it's a physical commodity, tangible, finite, sitting in vaults, warehouses, and industrial stockpiles. In the other world, it's a financial contract, a derivative, a series of promises exchanged between parties who may never touch an actual ounce of the metal. And here's where the story gets interesting. The second world is vastly larger than the first. For every physical ounce of silver that exists in deliverable form, there are estimated to be dozens, perhaps hundreds, of paper claims against that same ounce. This isn't conspiracy theory, it's market structure. The COMEX exchange, where most silver price discovery occurs, operates on a fractional reserve system. Traders can buy and sell contracts representing 5,000 ounces of silver while posting only a small percentage as margin. On a typical day, the notional value of silver contracts traded can exceed the total value of all the silver that could physically be delivered within the exchange's entire warehouse system. This creates leverage, enormous leverage, and leverage by its nature amplifies everything. When markets are calm and buyers are plentiful, the system works smoothly. Contracts are traded, positions are rolled forward. Physical delivery is rarely demanded. The paper market and physical market exist in comfortable equilibrium. But when stress enters the system, when liquidity providers step back, when forced selling begins, the leverage that made gains possible becomes the mechanism of destruction. Consider what happened during those 18 minutes. Large sell orders entered a market with thin liquidity. The first wave of selling triggered stop-loss orders positioned just below recent support levels. Those stops, once triggered, became market orders, meaning they had to be filled at whatever price was available. But there were no bids at those levels, so price had to fall further to find buyers. That additional fall triggered another layer of stops, which triggered another round of forced selling, which required price to fall even further to clear. This is what market professionals call a liquidity cascade. It's a self-reinforcing cycle where selling begets more selling, not because of fundamental changes in value, but because of mechanical market structure. Now, add another layer to this, algorithmic trading systems. These systems, which now account for a substantial portion of commodity market volume, operate on predefined rules. When certain technical levels break, when volatility exceeds certain thresholds, when order flow patterns match historical crash signatures, these algorithms don't deliberate. They execute, they sell, they pull bids, they reduce risk exposure automatically. During that night, multiple algorithmic systems likely identified the breakdown simultaneously and responded in unison. This created what engineers would call a positive feedback loop. Except there was nothing positive about it. The selling pressure from human traders was amplified by machine selling. The machine selling triggered more human stops. The human stops triggered more machine selling. And throughout this cascade, something else was happening in the background. The options market was being systematically destroyed. Silver options dealers who maintained neutral positions by hedging their exposure were forced to adjust their hedges as price fell. When price drops rapidly, dealers holding call options must sell futures to maintain their delta neutral positions. This dealer hedging added yet another source of selling pressure to an already stressed market. But here's the detail that should make risk managers uncomfortable. This entire sequence occurred during hours when major institutional players were not actively monitoring positions. New York was asleep. London was just waking up. Asian trading desks were staffed, but many Western institutions operate with reduced overnight coverage, which means that by the time decision makers were aware of the situation, the damage was already done. Positions had been liquidated, stops had been triggered, margin calls had been issued, and the market had moved, and there was no reversal mechanism. Now, contrast this with how the same market might have behaved if the selling had occurred during peak liquidity hours. During New York trading hours, there would have been more natural buyers. Market makers would have been fully staffed. Institutional traders would have been actively monitoring. The same amount of selling pressure might have resulted in a 2% decline instead of 6%. The difference between those outcomes isn't fundamental value. It's market structure and timing. This raises an uncomfortable question that few in the industry want to address directly. If market structure is this fragile, if timing can determine whether selling pressure causes a correction or a collapse, if the gap between paper claims and physical metal has grown this wide, then what happens when stress enters the system during peak hours? What happens when selling pressure isn't concentrated in 18 minutes, but sustained over days? What happens when the institutional players who usually provide liquidity decide simultaneously that the risk isn't worth the compensation? These aren't hypothetical questions. They're structural vulnerabilities that the overnight crash just exposed. The silver market didn't break that night, but it showed exactly where the breaking points are located. And in financial markets, once a weakness is revealed, once traders understand where the fragility exists, that knowledge changes behavior. It changes positioning. It changes risk calculations, because now everyone knows. The machine can be triggered, the cascade can be initiated, and when it happens again, and it will happen again, the question won't be whether the market can absorb the shock. The question will be whether anyone will be willing to step in and stop it. The overnight crash didn't happen in a vacuum. It happened at a very specific moment in economic history, a moment when multiple long-term trends were beginning to intersect in uncomfortable ways. To understand why this matters, one must zoom out from the 18-minute collapse and examine the landscape in which it occurred. Start with monetary policy. For the past 2 years, central banks globally have been navigating an impossible contradiction. They need to maintain restrictive policy to control inflation, but they also need to prevent financial system stress that tight policy inevitably creates. This balancing act has produced something unusual, a policy that's theoretically restrictive but practically accommodative. Interest rates remain elevated by historical standards, but liquidity provisions continue through various backdoor mechanisms. Quantitative tightening proceeds officially, while emergency lending facilities remain available quietly. This creates confusion in asset pricing, and when policy signals point in multiple directions simultaneously, markets lose their compass. And when markets lose their compass, they become reactive rather than anticipatory. They wait for breaks rather than positioning ahead of them. Silver, historically, has been sensitive to real interest rates, the difference between nominal rates and inflation expectations. When real rates rise, silver typically struggles because it offers no yield and costs money to store. When real rates fall or turn negative, silver becomes more attractive as an inflation hedge and store of value. But something strange has been happening recently. Real rates have remained elevated, yet silver had been climbing anyway. This divergence suggested that other factors were overriding the traditional relationship. Industrial demand, perhaps. Supply concerns, possibly. Or, and this is what some market observers had been quietly noting, positioning for monetary instability that hadn't fully materialized yet. When the crash occurred, it severed that divergence violently. It snapped price back toward what real interest rate models would predict. But the speed of that snap is what reveals the underlying tension. Markets don't correct efficiently when they're positioned for one scenario and reality delivers another. They correct chaotically. Now consider the broader commodity complex. Silver doesn't trade in isolation. It maintains relationships with gold, copper, platinum, oil, and broader industrial metals. These relationships aren't fixed, but they're observable. In recent months, something unusual had been developing. Gold, typically silver's closest relative, had been demonstrating remarkable stability. While silver experienced volatility, gold remained range-bound. While silver attracted speculative interest, gold attracted central bank accumulation. The gold-silver ratio, the number of silver ounces needed to buy 1 ounce of gold, had been compressing. Historically, this ratio averages around 70 to 1. In recent weeks, it had moved toward 80 to 1. This widening suggested that silver was weakening relative to gold. But more importantly, it suggested that the market was differentiating between monetary metals and industrial metals. Silver sits awkwardly between these categories. It's precious enough to serve as a monetary hedge, but industrial enough that its price responds to manufacturing and technology demand. This dual nature creates unique vulnerability. When monetary demand weakens and industrial demand softens simultaneously, silver has nowhere to hide. And that's precisely the macro environment that had been building. Industrial production data from major economies had been softening, not collapsing, but definitely decelerating. China, the world's largest manufacturer and silver consumer, had been posting growth numbers that looked solid on paper. But underneath, Manufacturing activity had been mixed. Demand for electronics, weak. Demand for solar panels, strong, but concentrated in specific regions. Demand for electric vehicle components, growing, but not at the exponential rates previously projected. This created an industrial demand profile that was stable, not expanding. Meanwhile, investment demand for silver had been showing signs of fatigue. Exchange-traded fund flows, which had been positive during much of 2024 and early 2025, had turned neutral. Not massive outflows, but the steady accumulation had stopped. Retail investor interest, measured by search trends and broker data, had plateaued. The enthusiasm that drives speculative positioning had cooled. When enthusiasm cools, but positions remain elevated, markets become vulnerable, because late-stage holders, those who bought near recent highs, tend to have weaker conviction. They're more likely to panic when price moves against them. They're more likely to be holding leveraged positions they can't afford to maintain through volatility. They're the fuel for cascades. Then there's the geopolitical dimension, not the dramatic type that makes headlines, but the slow burn type that affects commodity flows and strategic planning. Trade relationships between major economies had been recalibrating. Supply chains that once operated on pure efficiency were being redesigned for resilience. This was affecting metals markets in subtle ways. Countries were stockpiling certain strategic materials, but silver wasn't consistently on those lists. It fell into a gray zone, valuable, but not critical enough to warrant aggressive accumulation. This created a demand profile that was steady but uninspiring. No surge coming from strategic reserves, no panic buying from nations worried about supply disruption, just ordinary commercial demand meeting ordinary supply. When you combine all these factors, monetary policy confusion, real rate pressure, weakening gold-silver relationship, softening industrial demand, cooling investment appetite, elevated speculative positioning, you get a market that's structurally unstable, not obviously broken, but fragile, waiting for a catalyst. And on the night of February 5th, that catalyst arrived. Not as a news event, but as a liquidity event that exposed all the underlying fragility at once. The crash wasn't caused by macro factors, but macro factors determined why the crash was possible. They created the condition where a relatively small amount of selling could trigger a disproportionate response. They built the structure that could collapse. And now, in the aftermath, a new question emerges. If these macro conditions persist, if monetary policy remains contradictory, if industrial demand continues softening, if investment appetite doesn't return, then what happened overnight wasn't an anomaly. It was a preview, a demonstration of how quickly confidence can evaporate when the underlying support structure is weaker than it appears. And for business leaders managing commodity exposure, for manufacturers dependent on stable input costs, for investors holding precious metals as portfolio insurance, the macro context isn't background information. It's the terrain on which the next move will occur. And that terrain just became significantly more treacherous. The collapse is over. Price has stabilized, at least temporarily. Markets have moved on to the next headline. But for those who understand what just occurred, the real work is only beginning. Because the overnight crash revealed something that cannot be unrevealed. It exposed the exact sequence of events that can destabilize the silver market. It identified the price levels where stops are clustered. It demonstrated how quickly liquidity can vanish. And in financial markets, once a vulnerability is mapped, it gets exploited, not necessarily immediately, but inevitably. So the question facing business leaders, commodity traders, and portfolio managers isn't whether this will happen again. The question is, what gets done differently before it does? Start with the most immediate concern. Operational exposure. Any company that uses silver as an input, electronics manufacturers, solar panel producers, medical device companies, jewelry makers, just experienced a reminder. Commodity prices don't move in predictable patterns. They move in cascades. Cascades don't respect hedging strategies built for normal volatility. Consider a manufacturer who hedged 6 months of silver purchases using options. That hedge provided protection against gradual price increases. But during the overnight collapse, if that manufacturer had written covered calls to reduce hedging costs, those calls suddenly moved deep in the money. The hedge that was supposed to provide stability instead created losses. Or consider a company that relied on just-in-time procurement, buying silver on the spot market as needed rather than holding inventory. During the hours following the crash, bid-ask spreads widened dramatically. The market price became a fiction. There was no single price. There was a range between what sellers demanded and what buyers offered. And companies needing to procure physical metal during that window paid far more than the quoted futures price suggested. This is the hidden cost of market fragility. It's not just the price move itself. It's the breakdown of the normal relationship between paper prices and physical execution. For treasury departments and risk managers, this creates an uncomfortable realization. The models used to calculate value at risk and worst-case scenarios, the stress tests that supposedly prepare for market shocks, they didn't capture this because this wasn't a scenario where price moved against positions gradually. This was a scenario where market structure itself temporarily failed, where the assumption that positions could be exited at quoted prices proved false, where the liquidity that's supposed to exist in theory disappeared in practice. Now expand this concern beyond individual companies to portfolio construction. Many investors hold silver as part of a diversified commodity allocation, or as an inflation hedge within a broader portfolio, or as portfolio insurance against monetary instability. These positions are based on assumptions about how silver behaves relative to other assets. Those assumptions just became questionable. Silver is supposed to move inversely to real interest rates, but it had been defying that relationship. Silver is supposed to track gold directionally, but the gold-silver ratio had been diverging. Silver is supposed to benefit from industrial demand, but industrial demand had been softening while price remained elevated. When an asset stops behaving according to its traditional relationships, it means one of two things. Either the relationships have fundamentally changed, or the asset was mispriced and is now correcting. The overnight crash suggests the latter, which means positions held for diversification or hedging purposes may not provide the protection investors expect when broader market stress arrives. This matters enormously for institutional portfolios. Pension funds, endowments, family offices, these entities often hold commodity exposure as a tail risk hedge. The entire point is that when traditional assets struggle, commodities provide ballast. But if commodity markets themselves are fragile, if they can experience liquidity cascades during stress periods, then they're not providing the protection they're supposed to offer. They're adding a different kind of risk. So what does actionable intelligence look like in this environment? First, recognize that price levels now carry different meaning. The levels that broke during the overnight cascade are now known resistance points. If price approaches those levels again, expect defensive selling, expect stops to be placed just above them, expect algorithmic systems to be programmed to react if they break again. This creates a technical landscape where certain price zones become self-fulfilling, not because of fundamental value, but because everyone knows everyone else is watching the same levels. Second, understand that liquidity is not constant. The same market that can absorb selling during New York hours can collapse during Asian hours. This means position sizing cannot be based solely on normal hours liquidity. It must account for worst-case liquidity during periods when key market makers are offline. For firms holding large positions, this may require maintaining larger cash buffers, or structuring positions to be more easily exited, or accepting lower leverage ratios than profit optimization would otherwise suggest. Third, prepare for correlation breakdowns. When stress enters commodity markets, traditional relationships become unreliable. Assets that normally move together can diverge sharply. Hedges that normally offset exposure can fail simultaneously. This requires scenario planning that goes beyond historical correlation matrices. It requires asking, if the market structure itself becomes unstable, what happens to our positions? Not what do our models predict, but what could actually occur in a liquidity vacuum. Fourth, recognize that this event will change positioning behavior across the market. Traders who got caught in the cascade will modify their strategies. Some will reduce position sizes. Some will widen stop-loss levels. Some will exit entirely and wait for clarity. This changes the character of the market going forward. It potentially reduces participation, and reduced participation means lower liquidity, which means future moves could be even more violent. This creates a negative feedback loop where market fragility breeds caution, which breeds more fragility. Now, the scenario analysis. 3 potential paths forward. Path 1. This was an isolated event. Liquidity normalizes, confidence returns, price stabilizes and resumes trading within a predictable range. The macro environment remains stable enough that no further shocks materialize. This is the optimistic scenario. It's possible, but it requires that none of the underlying structural issues get tested again. Path 2. This was a warning signal. The macro environment continues deteriorating. Industrial demand weakens further. Monetary policy remains contradictory. Investment appetite doesn't return. In this scenario, silver experiences a sustained drift lower, not through dramatic crashes, but through steady erosion as holders gradually reduce exposure. This is the slow burn scenario. It doesn't create headlines, but it systematically destroys the positioning of anyone expecting a rebound. Path 3. This was the opening chapter. The fragility just exposed gets tested again under worse conditions, perhaps during a period of broader market stress. Perhaps when multiple commodity markets experience liquidity issues simultaneously. Perhaps when forced selling in one market triggers contagion into others. In this scenario, what happened overnight becomes the template for a larger unraveling, not just in silver, but across the commodity complex. This is the tail risk scenario, low probability, but high consequence, the kind of outcome that risk management exists to prepare for. So what happens next? That depends on which scenario unfolds. But here's what doesn't depend on scenarios. The market just demonstrated its breaking points. Everyone saw how it failed. Everyone saw how quickly confidence evaporated. Everyone saw how leverage amplified destruction. And in markets, once a weakness is revealed, it becomes part of the permanent tactical landscape. The overnight crash wasn't just a price move, it was an education. And the lesson was simple. The structure is more fragile than it appears. The safety margins are thinner than assumed. And when stress arrives, it arrives faster than preparation allows. For business leaders and investors, this leaves one clear imperative. Prepare now, not for the scenario you consider most likely, but for the scenario you cannot afford to experience unprepared, because the market just showed exactly what that scenario looks like, and it didn't send a warning in advance. It simply happened.